Welcome to the Vantage Plus podcast, Premium Trading Insider, a place where trading insights are shared and experiences are elevated.
Hi there, I'm Frank with the Vantage Plus research team. In today's episode, we'll cover the US election outcome with a focus on FOMC. US elections usually bring a wave of anticipation and volatility to financial markets, with investors closely scrutinizing candidates' policies that could shape the economy for upcoming years. In the 2024 election, key sectors like tax policy, healthcare, trade, and economic stimulus are at the forefront of market attention. Each area holds the potential to move markets significantly, from equities and bonds to commodities and currencies. Understanding these dynamics is crucial for navigating market opportunities during this pivotal period. At first, tax policy was at the focal point of Donald Trump's administration, significantly benefiting NASDAQ-listed tech companies. His 2017 Tax Cuts and Jobs Act reduced corporate tax rates from 35% to 21%, boosting profit margins for tech giants and fueling growth-focused reinvestments. This policy supported innovation and stock buybacks, which drove the NASDAQ to record highs. Tech-heavy companies, sensitive to taxation levels, thrived under this low-tax environment, reinforcing the sector's dominance and investor confidence during his tenure. After Trump had been re-elected, indices went to the upside. Despite the stronger dollar, markets geared up momentum again. The NASDAQ was also able to defend the psychological 20,000 level, with potential upsides to continue for now. Healthcare policy is a crucial driver for the Dow Jones Industrial Average, which includes key players like United Health Group, whose CEO has just been killed by an assassin. Major reforms, such as the Affordable Care Act in 2010, caused significant volatility as investors assessed its impact on insurance and pharmaceutical profits. Similarly, Donald Trump's 2016 campaign to repeat the ACA introduced uncertainty affecting healthcare-heavy Dow components. The Dow Jones Index has not only surpassed its all-time high, but also climbed nearly 7% since Donald Trump's election. Optimism surrounding the economy, particularly expectations of increased spending on insurers and hospitals, could further support the market to new heights. Any technical retracement could provide opportunities for entry into long positions. Trade policy has significantly impacted oil markets, especially during Donald Trump's presidency starting in 2016. His tariffs on Chinese goods and anti-globalization stance heightened fears of a trade war, reducing global growth expectations and pressuring oil demand. On the other hand, Trump's America First energy policies included deregulation and boosted domestic production, increased US oil output, but created oversupply concerns. Currently, technical patterns in the oil market might offer a further decline. As the monthly chart shows, downside momentum might occur. Only a break of the 50 moving average above, which currently acts as a technical resistance area, could indicate that the market is going to stabilize. Economic stimulus during Donald Trump's presidency played a significant role in gold price movements. In 2020, pandemic-driven relief packages supported by the Trump administration increased government spending, raising concerns about inflation and fiscal deficits. These factors often weakened the dollar, enhancing gold's appeal as a safe haven asset. Additionally, Trump's pro-growth fiscal policies created mixed sentiment, while they fueled economic optimism. The increased uncertainty from political and economic debates kept gold in demand as the hedge against volatility during the election year. The gold price is currently declining after having tested the 2,785 level. Only a break of the recent all-time high might indicate further potential to higher levels. Since the dollar had started to weaken slightly, this might be the case in the coming month ahead. Then, a test of the 3,000 US dollar zone might happen, which really depends as well on the dollar. As the inauguration of Donald Trump is near, financial markets will potentially face some volatility in the coming weeks ahead. Traders should hence focus on affected economic policies and focus on the aforementioned sectors. Gold remains a hedge against fiscal uncertainty and potential inflation deriving from stimulus discussions, while euro-dollar will likely be influenced by both election-driven volatility and the upcoming FOMC meeting. The euro-dollar currency pair is currently trading right on top of the key technical support zone at 105. The Federal Reserve's stance on interest rates could influence sentiment, with hawkish signals likely supporting the dollar and dovish signals providing support for the euro. Another rate cut in December may follow, so traders should brace for increased volatility in the coming weeks.
Keep your trading edge sharp. Till next time. Vantage Plus, Experience Plus.